let's sort of start with what we mean by angel investing. So an angel investor is someone who's using your own money to do investment in a startup. So we want to distinguish those that are angel investors from those that are good angel investors, and talk about those investors that take the time to figure out what the company is doing and understand clearly whether this is a good company or not. And so we know that there are some people who invest quickly based on some impulse that they find interesting, and we want to try to help people be a little bit more data-driven and be more thoughtful about their angel investing and do a good job to build a good portfolio that works for them. So in the United States, we have this magic line that says, if you're accredited, then you can invest in unregistered stocks. If you're not accredited, you are limited to buying registered stocks. And the accredited is, you have to have 200,000 in income each year, or 300,000 with your spouse, or you can have $1 million not counting your primary residence, or you can be an entity, a trust being one of those entities, but it can be nonprofits as well that have assets over 5 million. The interesting thing is that being accredited doesn't mean that large numbers of people are doing it. So only about 1% of the people in the United States who are accredited actually write checks, and about 10% of the population is accredited. We want to distinguish a startup from a small business. Usually when we're doing angel investing in the Seattle context, we're looking for growth companies, companies that will have some mechanism to get big and hit scale. So that means when we invest, we're investing in companies that are relatively risky, and that risk gets covered by the fact that some of them pay off, and we'll talk about that process. A small business, on the other hand, is a business that does not plan to grow and be very big. So if you're a small business, you're running along just fine with a high margin, but you don't plan on having exponential growth, then in the Seattle context, they typically are not interested in that kind of company. And then back to this deal terms, we're doing an angel investment or an angel conference in Anchorage, Alaska. And Anchorage has quite a different company mix than what we see in Seattle. And so they are looking at a different set of deal terms, one that Looney has used called revenue redemption, as a mechanism by which they might expand to a broader set of companies. When we talk about venture investing, everybody jumps to venture capitalists. One of the things that happens with venture capitalists is venture capitalists are professionals that run a fund that spend other people's money. So they have a very different view. And since they're trying to be paid for doing this work, where angel investors are typically doing the work themselves, that means that they need to have relatively large funds so that they can take an appropriate fee so that they can pay their salaries. To do that, they want to be in the 10 million to 50 million range for doing seed level stuff, and maybe much, much bigger if you're going on to later stages. Almost all of the work that venture capitalists is doing is aimed at the few huge exits. And so there's this ongoing conversation about unicorns and the possibility of being over $1 billion company. That is one possible pathway for how to think about startups from an angel investor point of view. We usually have maybe 20-25% of our angel investors that are coming into our program sort of believe in the unicorn, get big, and then make money story. However, angels investing their own money generally means that the angels tend to be at the early stages, venture capital tends to be at the later stages.